Hi, I'm Matt Reese and this is 3 Minute Tech. These are the videos where we cover your strategic financial planning questions without any of that technical jargon. Now in today's episode, we've got something that I think really provides a lot of value for your family and mine. It's an important area that's going to impact a lot of people, and I encourage you to sit down, think about it and speak to your family about it, because the opportunities are quite significant. So in today's episode, we'll be talking about something that's a little bit morbid, because Australia is about to embark on the biggest intergenerational wealth transfer in history. In fact, over the next 2 decades, $3.5 trillion will move between generations. And by 2050, up to $237 billion will move in a single year. So today we'll be talking about what are some of the tax implications when you're inheriting common assets such as shares or property. So, does Australia have death taxes? It's a question that we get asked quite a bit, and the answer is no, but. And what I mean by that is death taxes were abolished in 1978. And in fact, for historians out there, Australia was one of the earlier countries to abolish these taxes. Does that mean there's no tax to be paid? Well, unfortunately it doesn't. And the tricks and the traps are in the detail. So the tax office doesn't miss out. The way that they get their tax is based on capital gains. So the difference between what you bought it at versus what you sell it at. Now capital gains is that difference, but equally, if you're holding the asset for greater than 12 months, you get a discount, a 50% discount in fact. So it's important to also consider this. So what are the tax considerations when you inherit shares? Well, if the deceased acquired the shares prior to the 20th September 1985, well, you'll inherit the cost base or the purchase price based on the value at their death. On shares acquired post the 20th of September 1985, well, the cost base will be based on how much the deceased purchased them for, which may mean there's a bit more capital gains to be paid. So what about property? And what about a property that was the deceased's principal place of residence? Well, if it was their residence and they weren't using it to produce income, you inherit that asset capital gains tax free, as long as the asset and the property is sold within 2 years. Selling it post 2 years may mean there's some small capital gains to be paid. So we've covered off a principal place of residence. What about an investment property? Well, if you inherit an investment property that was used to produce income by the deceased, if it was purchased post the 20th of September 1985, then you'll pay tax based on their initial purchase price. If it was acquired prior to the 20th of September 1985, then again, you'll have 2 years to be able to sell it without any capital gains. So if you inherit some of these assets and there are capital gains to be paid, what can you do? And it's a very common question that we get from clients. Well, for one, you can talk about some of these estate planning and tax concerns prior to the passing of a loved one. It may be in fact that they're at a lower marginal tax rate than you are whilst you're working. So some of these assets can be realised during their life. Otherwise, superannuation can be a fantastic vehicle about moving money into a tax advantaged vehicle and get a tax deduction along the way. So that's also another useful tool. Francine is 91 and unfortunately she passes away. Coming from a farming family, she passes on $27,500 worth of Wesfarmers shares to each of her children. Now, one of her children, Jonathan, is still working and he's on a marginal tax rate of 39%. So he's conscious about the tax consequences when he goes to sell these shares. Now, keeping in mind, Francine acquired these post the 20th of September 1985, there are some capital gains tax issues to be aware of. So what does Jonathan do? Well, he elects to contribute all of these shares into his self-managed super fund and claim it as a tax deduction against his concessional cap. The net benefit is he increases his self-managed super fund by $27,500. He doesn't have to pay any tax in his personal name, and in fact, he actually gets a tax refund based on the acquisition price of his mum. A fantastic result and something that can only be done if you give forward planning the opportunity. So what have we learnt today? Well, we know death taxes in Australia were formally abolished in 1978, but unfortunately that doesn't mean there aren't tax considerations to be had. All it means is we need to give it a bit more prior planning prior to realising some of these assets, and equally get the whole family involved in these discussions. So now we're back out of the office, what did we learn? It's an important point just to sit down and have a think about what we covered today and how it might impact you or your family. As always, please reach out to us. We're happy to share and help out in any way that we can.